Welcome to the Greatest Lessons series. I'll highlight the most important lessons taught by Benjamin Graham by using my longer videos to showcase them. Today's greatest lesson is market fluctuations, or as Benjamin Graham likes to call them, Mr. Market. And as always, if you enjoy the episode, liking the video, subscribing if you haven't done so already, and hitting the bell for notifications is greatly appreciated. So what he's saying is, Mr. Market is a personification of the market. Benjamin Graham transforms the abstract idea of a market into a person. Next is that price does not equal value. Just because it's selling for $100 does not mean that it's worth $100. Don't let yourself get ripped off. Then there's timing versus pricing the market. And there's two ways to catch in on the erratic fluctuations in the market, with Benjamin Graham's opinion on both. Let's watch a short segment of my longer series on Benjamin Graham. Now we can get into Mr. Market and market fluctuations. You might be wondering, who is Mr. Market? He's a personification of the stock market as a whole, and he's a very peculiar salesman who doesn't really know what his goods are worth. What's the purpose of this personification of the stock market? It's to better explain why there is volatility in the markets, and also to understand that price does not equal value. Graham is trying to make the stock market seem less abstract. And so you might ask, can you give an example of what this is like? And I can give something somewhat close, and I'll try to personify Mr. Market as a strange car salesman later on. Mr. Market is all about market fluctuations. So how can you make money with market fluctuations? The first of which is timing the market. And the second is pricing the market. So the first of which, timing the market, that's when you're buying when the market as a whole is really low and selling when it's really high. As for pricing the market, this is determining the value of an asset and buying when it's lower than your estimate. And now let's get into the results. If you played, I'd love to hear your results in the comment section below. I set up the game to start as a bullish market and end in a recovering crash. Optimally, you should have bought everything as it was going up and sold before each time it was going down, in which case you would buy low and sell high. You can see the bottom right box for more details. Starting with our $10,000 and following the same offers that I gave to you, that means optimally making $27,540 in the end. So how close to that number did you get? If it wasn't obvious in the previous examples, Benjamin Graham is not a fan of timing the markets. He feels that it's a total waste of time and effort, and it's totally based on speculative elements. Instead, he prefers pricing the market, in which you're buying based on your own evaluation. And Mr. Market's salesman qualities is how we're going to explain this. Mr. Market is persistent. He makes me an offer every single day. He also doesn't care if I keep turning him down, because I'm not forced to buy anything, and he doesn't really care if I do or do not buy. Another quality of him is that he's clueless. He doesn't know what his products are worth. He increases and decreases the prices based on what people bought or sold recently. My qualities as a rent-a-car business owner. I am knowledgeable about cars and I know how much they're worth. I'm also frugal. I like buying quality products at a discount. As for my business, these are the criteria that I'm looking for in my rent-a-car business. The first of which is safety of the vehicle, the miles per gallon, the extra features in the vehicle, and the space being offered. Cars that are trying to be sold to me and my evaluations of them are listed below. In which case, my 2018 Ford Fiesta, I feel a fair evaluation at the time being $14,200. The Chevrolet Sonic, the evaluation I'm giving at the time was $15,300, and the Nissan Versa, the evaluation I'm giving at the time, $12,000 for fair prices. Not what I want to buy them for, but fair prices. Let's get into our Mr. Market scenario, day number 1. He is the salesman and he's trying to give us sales for all of these vehicles for our rent-a-car business. But since it's day 1 and he doesn't know what anything's worth, he decided just to price everything at $30,000. So it's $30,000 for our Ford Fiesta, Chevrolet Sonic, and Nissan Versa. As we can see, all of these are way above our target marks for a fair price, so we're just going to ignore his prices and say no thanks, and hope that a better deal will come tomorrow. Day 2 comes around and we are correct. We do get better prices waiting instead of buying from yesterday. Now, the Ford Fiesta is being listed at $22,000, Chevrolet Sonic at $19,000, and the Nissan Versa for $15,000. As we can still see, all of these numbers are way above our fair evaluation price. So once again, just like day 1, we're just going to ignore Mr. Market, say no thanks, and hope that tomorrow a better deal will be available to us. Day 3 comes and we might be confused because all the prices went up. This might be because of the sudden drop in all the prices making people want to buy from yesterday. We look at our evaluation and see this is still way too high and decide not to buy any of the cars. Even if the prices go up, it doesn't mean our evaluation goes up to match it, and because of that, we'll continue to wait. Day 4 comes around and we start to catch a break because as we can see in the far right side of the screen, the Nissan Versa is now listed at $6,000. We look at our evaluation of what is fair and it is listed at $12,000. So we might be confused once again. Is this the case that the price is incorrect, or is it rather that our evaluation is incorrect? Since we are experienced and know what cars are worth based on our own personal evaluations, we decide that the market is incorrect instead of ourselves. And as such, we decide to buy a lot of Nissan Versa cars. As for the other cars, such as the Chevrolet Sonic, we see that's below our evaluation. However, even though it is below our fair value evaluation, it's not that low compared to the Nissan Versa. And we prefer buying things on discount so that we can have higher returns in the future. And as such, we decide to only buy the Nissan Versa cars. Day 5 hits, and that means it's the last day in the stock market. We have our 2018 Nissan Versa going back closer to its fair valuation mark, and we see now it is instead the Ford Fiesta car, which is far below our fair valuation price. It is below the 2/3 mark based on our evaluation, and we decide that is a decent time to be purchasing the Ford Fiesta car. And as such, just like we did on day 4, we're going to be purchasing a lot of the Ford Fiesta cars since it is significantly lower than our fair evaluation price. Once again, the Chevrolet Sonic is not below a significant portion of our evaluation, so we decide to leave that alone entirely, just like we have every other day in the week as well. So did I have any idea what the price would be the next day? There's no way I could even guess that. Sometimes prices went up even when they were already above what I considered a fair evaluation. And price drops seemed to come out of nowhere. But did I know when a decent time to buy was? And that is a yes. My personal evaluation was always the same number no matter what was happening outside of that. And we can choose to hold long term or sell accordingly based on our fair evaluation price. I recognize that choosing cars and using Mr. Market as a car salesman is a much more simplified version than the stock market as a whole, but this was just a very easy personification to help explain that the market prices are not rational and that you shouldn't be using timing the market to make money. You should be using pricing the market to make money instead. Thank you so much for watching to the end of the episode. And if you're interested, consider joining with the Market Moves Investing Book Summaries link in the description down below.